Increased government intervention through regulation and legislation has had a negative impact on creativity and innovation in the insurance industry. We spoke with Ty Sagalow recently to get his thoughts on public policy and how a partnership with the insurance industry could actually spur new product development. He is president of Innovation Insurance Group and over a 30-year career has been involved in several major product innovations, from D&O and reputation insurance to IP coverage and others. Here is what he had to say.
So regulation, when appropriately done, can be a value added both to the industry as well as to the customer base. Customers like to know that there are set rules. And believe it or not, the insurance industry likes to know when there are set rules. However, regulation, when it goes too far or runs amok, can be a stranglehold on innovation and creativity and ultimately satisfying customer needs. When regulation gets to a point where efforts are being put in to be compliant for compliance reasons only, then we have fallen way behind the curve. As a new product expert, I love legislation. There is nothing like Congress passing new liability to prompt the insurance industry. And there are countless examples. I remember in 1974, ERISA, the Employee Retirement Income Security Act, created the new liability under ERISA Section 404 of an ERISA fiduciary. Within 90 days of the passage of that law, AIG came out with the first fiduciary liability insurance policy. 1991, the Civil Rights Act. Shortly thereafter, sexual harassment insurance and wrongful termination insurance. Even the phenomenon of Y2K and the Y2K Act prompted the creation of a Y2K insurance policy. Look at cyber risk today. Year 2012, we read about distributed denial of service attacks against our largest financial institutions, allegedly all started by a nation state. Today in the Times, we read about attacks against major corporations, allegedly launched by a group affiliated with the Chinese government. Today we have a need for an executive order in cyber, which occurred just 1 week ago. And we have many, many bills pending in front of Congress. We have a cyber army in the United States and in other countries as well. Terrorism is such a difficult risk, especially in today, where there is not just physical attacks, and it's unclear whether it was launched by Al-Qaeda or whether it was launched by a hostile nation state, but cyber attacks as well, which is almost impossible to really know what the origin is. There's been a war exclusion in the insurance policies for decades. But today, what is war? What's the difference between war and terrorism? The answer continues to lie in a public-private partnership. And that's why the Terrorism Risk Insurance Act, TRIA, is probably going to be renewed. It all comes down to execution. Crop insurance have had some difficult times because, frankly, it's priced incorrectly. It's priced so that the federal government will lose money and that therefore it's constantly under criticism. But I believe the correct type of public-private partnership, the types that are evidenced by the Safety Act, for example, that encouraged the creation of innovative anti-terrorism technology and gave private sector incentives, including liability incentives, for those companies that, in the words of Pamela Newman, dared to be great. So I think the right type of partnership at the right time works, and I believe that type of partnership is needed today in terms of cyber risk.
For more of our discussion with Ty Sagalow, visit our on-demand library. And look for Ty's new series called Innovations in Insurance, coming this March on RIN TV.